Something quietly happened with SCHD, and most investors missed it entirely. Whether you're new to SCHD or frustrated with the recent performance, watch this before you make your next move. This single change could completely reshape how you view SCHD going forward. It's not about the share price, it's not about yield, it's something deeper, something that signals where dividend investing is heading in the next 5 to 10 years. And I'm not exaggerating, because when you look beyond the share price and focus on what's happening inside SCHD, you realize this ETF is slowly transforming, adapting to a new market reality that most investors haven't caught on to yet. If you hold SCHD for income, retirement, or long-term compounding, you need to understand what's going on. This isn't just a normal rebalance or a dividend tweak, it's a signal. A signal that the way SCHD is positioning itself for the next 5 years could look very different from how it performed in the last 5. Quick disclaimer, I'm not a licensed financial advisor. This video is based on my personal opinions and experiences, shared purely for educational purposes. It's not financial advice. Always do your own research or consult a licensed professional before making any investing decisions. Let's dive in. I've been following SCHD for years. It's one of those ETF that built its reputation without fanfare. No marketing gimmicks, no flashy promises, just a proven formula. Consistent dividend growth, high-quality companies, and simple rules that outperform over time. But lately, something changed. At first, I almost missed it, because SCHD doesn't announce anything dramatic. It just adjusts, smoothly, silently, strategically. And that's exactly what happened this time. Let me be clear about what makes SCHD special. This isn't your typical dividend ETF that simply chases the highest yields. SCHD tracks the Dow Jones 100 index, which screens for companies based on 4 critical factors: dividend consistency with at least 10 consecutive years of dividend payments, financial health through strong cash flow relative to debt, return on equity, measuring efficient use of shareholder capital, and dividend yield that's attractive but sustainable. This methodology has made SCHD a favorite among serious income investors, with an expense ratio of just 0.06% and a current yield hovering around 3.5 to 3.8%. It strikes a balance that few ETF achieve meaningful income today with the potential for growth tomorrow. This is what changes everything. Every year, SCHD runs a portfolio rebalance, meaning it reevaluates every company it holds based on dividend strength, cash flow, and financial health. That's normal, but this time something stood out. Some of SCHD's longtime core holdings, names that defined its stability, were adjusted or reduced. And the replacements? They're not the kind of companies you'd expect in a traditional dividend ETF. The 2025 reconstitution brought significant changes. 20 new stocks were added while 17 were removed. Notable additions included Merck returning to the index, ConocoPhillips becoming the new top holding, and Schlumberger enhancing energy exposure. Then Target adding consumer defensive strength. It's a subtle yet meaningful change, signaling how SCHD is adapting to navigate the new economic cycle ahead. Because right now we're in a world where corporate debt dynamics are shifting. The Federal Reserve has cut rates twice in 2025, and dividend safety actually matters more than yield chasing. And SCHD seems to know it. Here's where things get really interesting, and where most investors completely missed what happened. SCHD sector allocation underwent a dramatic shift during the 2025 reconstitution. The changes reveal a fund that's positioning itself for the economic environment ahead, not the one we just left behind. Financials constitute approximately 9% of SCHD's portfolio, positioning it to benefit from a normalized rate environment and economic stability. Healthcare makes up around 16.6%, offering defensive exposure with pricing power and recession resilience. Consumer staples represent about 18%, providing stability through essential goods firms in uncertain times. Industrials account for roughly 12.2%, giving exposure to infrastructure spending and economic expansion. Energy sits near 19.3%, which is a key story. SCHD's exposure to energy has grown significantly in the latest reconstitution, but massive exposure like that could either help SCHD or hurt it, and I'll walk you through my full reasoning in this video. It's not bad that information technology is sitting around 8.4%, reflecting a deliberate focus on mature, dividend-paying tech names. Other sectors such as utilities and materials hold smaller allocations, rounding out the fund's diversification. The biggest shift is energy climbing above 20% of the portfolio. With ConocoPhillips now leading the holdings and Schlumberger added, SCHD is clearly positioned to capture stability and strong cash flow from the energy sector in an inflationary environment. This is remarkable because SCHD's rules cap any single sector at 25%, and energy is now approaching that threshold. This signals confidence that energy companies, particularly those with strong balance sheets and consistent dividends, will be critical income generators in the years ahead. But what if the market doesn't favor the energy sector? What happens to SCHD and its dividend investors? That's the part most people aren't thinking about. Meanwhile, financials make up approximately 9% of the portfolio, indicating a modest allocation in contrast to larger weightings in energy and consumer staples. This positioning may reflect SCHD's emphasis on dividend-quality companies rather than high financials exposure. Most people think SCHD is just a buy-and-forget ETF, but the truth? It's quietly reshaping itself, cutting weak companies, adding reliable earners, and locking in long-term income potential. During its latest rebalance, SCHD showed a subtle but important shift. The ETF didn't just adjust its holdings, it strategically positioned itself for an economy with persistent inflation, energy security challenges, and a demand for reliable, sustainable cash flow. That's unusual for what many perceive as a static, defensive fund. Traditionally, SCHD was known for its defensive posture, the usual classic dividend name that have been paying for decades. But this year's rebalance tells a different story. In short, SCHD is evolving. It's not stepping away from dividends, it's doubling down on them. The focus is on quality and resilience, companies that can maintain payouts in tough times and grow when markets are strong. The heavier weight in energy is a strategic move. Established energy firms with strong cash flow and shareholder-friendly policies are well positioned to benefit from ongoing demand while funding the shift to cleaner energy. These companies generate cash and return it to shareholders through dividends. Here's where the macro picture matters most. With the Federal Reserve cutting rates twice in 2025, bringing the benchmark down to 3.75% to 4.0%, income-focused ETF like SCHD are now positioned to take advantage of the easing cycle. When interest rates were high in 2024, dividend ETF had a tougher environment. With high-yield savings accounts and treasury bills offering attractive returns, some investors shifted towards safer options, making it more challenging for dividend-focused funds to stand out. But as rates come down, the story flips entirely, with SCHD's yield around 3.5% to 3.9%, and inflation expectations hovering above 2% on a multi-year basis. Dividend-focused ETF may attract capital as investors seek income and growth together. SCHD's strategy, companies built to pay and grow dividends, positions it for an environment where inflation matters more than ever. This is the environment SCHD's latest rebalance anticipated, by ensuring its holdings maintain strong balance sheets and sustainable payout ratios. Now SCHD is positioning itself perfectly for the next phase of the economic cycle. The energy overweight makes even more sense in this context. Energy companies tend to perform well during inflationary periods and provide natural hedges against rising prices, exactly what investors need when inflation remains persistently above the Federal Reserve 2% target. So what actually sets SCHD apart from other dividend ETF? While funds like VYM or SPYD often focus on higher yields, SCHD targets companies with strong return on equity and consistent cash flow. That's what keeps it lean, profitable, and insulated from debt-heavy dividend traps that crumble in bear markets. This is why SCHD often falls less in downturns and recovers faster in uptrends. It's not luck, it's structure. When you screen for high return on equity, you're identifying companies that efficiently convert shareholder equity into profits. When you prioritize cash flow over accounting earnings, you ensure dividends are supported by real cash generation, not financial engineering. This methodology creates a compounding effect over time. Companies that consistently grow their dividends while maintaining strong return on equity tend to see their stock prices appreciate, alongside their payouts. This dual source of returns, capital appreciation plus growing income, is what makes SCHD so powerful for long-term wealth building. Think about it this way. A dividend yield around 3.7% to 4.0% that grows over time can compound very differently than a higher yield that stays the same. Over the years, a growing dividend stream can provide increasing income and may reflect strong underlying businesses, which often supports share price growth. Here's the first move SCHD made that changed the game. It raised its quality standards, focusing on companies with strong cash flow and reliable dividends. Simply put, SCHD enhanced the overall quality of its portfolio while strategically leaning into sectors generating solid cash flow. Every year, the Dow Jones U.S. Dividend 100 Index is reviewed and reconstituted, usually in March. To qualify, companies must be U.S.-based, have a strong track record of paying dividends, and meet strict fundamental screens, including dividend yield and overall financial health. From this pool, the top 100 ranked stocks are selected and weighted according to the index rules. Companies that no longer meet these standards due to weakening cash flow, higher debt, or concerns about dividend sustainability are removed. At the same time, emerging dividend leaders with improving fundamentals are added. This isn't reactive management, it's proactive portfolio optimization. In 2024 to 2025, this process reflected the new economic reality: persistent inflation, energy security challenges, and a need for companies that can generate real cash flow. Here's the surprising part. SCHD didn't make a big announcement. No viral press release, no social media hype, not even a headline shouting SCHD makes a major energy move. Yet if you dig into the fund's latest holdings and study the sector shifts, it becomes clear. SCHD quietly repositioned itself for a very different economic environment. This is what separates a truly strategic ETF from one that's merely passive. Most investors miss this because they only focus on the yield. Seeing it around 3.5 to 3.8%, they assume nothing's changed. But behind the scenes, SCHD is quietly laying the groundwork for long-term growth. The yield actually dipped slightly by 0.07% after the reconstitution, landing at roughly 3.81%. This wasn't a mistake. It was deliberate. SCHD prioritized sustainable dividend growers over chasing high yield, favoring long-term compounding instead of short-term spikes that aren't maintainable. Consider high-yield ETF like QYLD or RYLD. Their yields may look impressive thanks to strategies like covered calls, but their long-term growth and capital appreciation are often minimal or even negative. These funds trade tomorrow's growth for today's income. SCHD takes a different approach. It's not about flashy yields, it's about sustainability. That's where its strategy shines. While high-yield chasers focus on this quarter's payout, SCHD investors are thinking in decades, not months. Here's what I love about reinvesting SCHD's dividends. In the first year, we're earning around 3.6% on our original investment. But as the companies raise their dividends, that yield on cost keeps growing. A few years in, it might be 4 to 5%. And over a decade or two, it can really snowball. This compounding effect is exactly why I've made SCHD a core part of my long-term income strategy. But this only works if the underlying companies can sustain and grow their dividends. That's where SCHD's quality screens are crucial. By filtering for financial strength, it significantly reduces the risk of dividend cuts that could derail compounding. The energy sector, allocation strengthens this strategy even further. Energy companies with solid balance sheets have historically maintained dividends through commodity price swings, and SCHD's current energy holdings are among the most financially disciplined in the sector's history. And that's just the start. What comes next is even more revealing. SCHD's approach is quietly brilliant. It doesn't chase headlines, trade constantly, or play the Fed game. Yet it continues to outperform most dividend ETF. If you're holding it, here's why that matters. You own an ETF that's evolving and improving automatically without you lifting a finger. Think about that for a second. Most funds just track the same index year after year, no matter how the world changes. SCHD, however, evolves through its annual reconstitution. When dividend stocks start to falter, slowing growth, rising debt, or inconsistent payouts, they're quietly removed. When new companies demonstrate consistent strength, growing dividends, expanding margins, and strong returns on capital, they're added. Even though you don't see it day to day, SCHD is constantly reshaping itself for the future. And here's what most people overlook. These small incremental changes compound significantly over time. The sector allocation shifts aren't random. They're based on careful analysis of which sectors can sustain dividend growth across different economic environments. The 20% allocation to energy, for example, is backed by companies with fortress-like balance sheets and reliable cash generation that persists regardless of short-term price swings. Now here's where it gets really interesting for SCHD holders. You won't want to miss this. With the Fed cutting rates twice in 2025 to 3.75% to 4.0%, we're entering a period of moderately lower interest rates, which is a real tailwind for a quality dividend ETF like SCHD. As rates fall from their peaks, SCHD's yield becomes more attractive relative to treasuries and money markets. Capital flows back into dividend equities, and companies with manageable debt benefit from lower borrowing costs, improving cash flow available for dividends. Lower discount rates also support higher valuations for reliable dividend payers, while income-focused investors start looking for alternatives, and energy companies in particular benefit as capital costs decline but demand remains robust. SCHD's positioning ahead of this rotation isn't a mistake. The fund naturally favors companies with strong balance sheets, consistent cash generation, and the ability to grow dividends even as the economic cycle matures. But what if the heavier energy concentration doesn't play out as expected? Could it lead to underperformance? That's exactly why the next phase is so important to watch. SCHD's next major reconstitution usually happens around March, and this upcoming one is going to be especially interesting. After the dramatic sector moves we saw in 2025, the March 2026 update will show whether SCHD's bigger energy position was the right call, or if the fund needs to shift again. We could see the energy allocation stay elevated if those companies keep producing strong cash flow and steady dividend growth. Financials may gain more weight if the economy continues to hold up, and healthcare will likely remain a major pillar, given its defensive nature and the long-term tailwinds from an aging population. None of this means SCHD is drifting away from its core philosophy. It simply means that within its strict quality standards, the portfolio has room to adapt toward the dividend leaders of the next decade. What makes SCHD so powerful is its annual reconstitution. It prevents the portfolio from being stuck with yesterday's winners. Companies have to continuously prove their financial strength and dividend reliability, creating a built-in natural selection process that keeps the fund sharp. For anyone focused on long-term income, understanding how SCHD evolves is absolutely essential. Here's how I think about using SCHD strategically. If you're in that stage of life where retirement is getting closer, maybe 5, 10, or even 20 years away, SCHD can play a key role in building reliable income for the future. Personally, I reinvest the dividends automatically. I don't chase short-term moves, I just focus on growing my share count and letting time do the heavy lifting. The beauty of SCHD is that it's built around strong, established companies, the kind that have weathered decades of market cycles and still keep rewarding shareholders. For those who are nearing retirement, this is really where SCHD starts to show its strength. After years of steady investing, our portfolio begins generating meaningful income based on the original investment over time. That income can grow as the companies within SCHD raise their dividends, helping to keep cash flow strong while the fund continues to focus on quality. And with its energy exposure, SCHD adds an extra layer of protection during periods of rising costs, something many retirees appreciate. I'm not telling you to use SCHD as a retirement hedge. This isn't financial advice, I'm just sharing how I personally look at it and why I think its approach to quality and consistency makes it worth paying attention to. But there's another crucial aspect of SCHD that doesn't show up in performance charts. When markets crash, and they will sometimes, dividend investors with quality holdings like SCHD tend to panic less. Why? Because even when our account value drops 20%, we're still receiving and potentially increasing dividend payments. During the 2024 market volatility, SCHD's defensive positioning and quality focus showed its value. While growth stocks experienced dramatic swings, SCHD's diversified dividend approach provided steadier returns. This psychological buffer is invaluable. It helps us investors avoid the classic mistake of selling low during market turmoil. Instead of watching a number on a screen drop, we're focused on a growing stream of actual cash distributions. This behavioral advantage, compounded over decades, is worth far more than most investors realize. Staying invested through volatility is the single most important factor in long-term wealth accumulation, and SCHD's structure helps facilitate exactly that mindset. SCHD's commitment to reliable U.S. dividend companies might seem limiting in a worldwide economy, yet it's a deliberate strategy that actually works in its favor. The U.S. is known for being very shareholder-focused. Companies often return value through dividends and buybacks, and the market benefits from deep liquidity and strong governance standards. Together, these factors create an environment where consistent dividend payments are a priority. Outside the U.S., even in developed markets, companies may not prioritize shareholders as strongly. Dividends can be irregular, and cash might be used for other purposes. By concentrating solely on U.S. dividend achievers, SCHD takes advantage of a system built to reward patient income investors. With around 103 holdings across multiple sectors, it still offers plenty of diversification within that focused universe. Even though SCHD is U.S.-focused, its heavy weighting in the energy sector still gives global exposure. These companies operate worldwide and profit from international energy demand. Here's a part of SCHD most people still overlook. It's surprisingly tax efficient for a dividend ETF, because SCHD holds established, profitable U.S. companies. Most of its payouts qualify as qualified dividends. For many investors, that means those dividends are taxed at long-term capital gains rates instead of regular income rates. A huge difference in how much you actually keep. That alone makes SCHD especially appealing in taxable accounts where tax efficiency really matters. Compare that to something like certain business development companies, which frequently distribute income that's taxed as ordinary income, and SCHD immediately stands out. And with SCHD yielding above 3.8% and increasing those payouts each year. I'm not just earning more income, I'm keeping more of it. So after looking at everything, should SCHD be in your portfolio? It comes down to your goals. SCHD shines if you want steady, rising dividend income instead of the highest possible yield. It's built for investors who prioritize quality, durability, and a long-term horizon, and who like the idea of automatic, rules-based rebalancing every year. It also fits well if you want broad sector exposure, tax-friendly dividends, dependable cash flow from energy, and some inflation resistance through dividend growth. But it may not match your needs if you want the highest income right now, if you prefer fast-growth tech exposure, if you dislike the energy weighting, if you want to make your own sector calls, or if you have a very short investing timeline. It also won't satisfy investors looking for international dividend exposure. For most long-term investors building retirement income, SCHD covers almost everything that matters. It's not flashy, it won't explode overnight. But it consistently does what it was built to do. Compound wealth through high-quality dividend growth while adapting to shifting market conditions. That's exactly why it continues to be one of my favorites. In a world defined by volatility, uncertain Fed policy, global tensions, and non-stop technological shifts, SCHD stands out as something rare. A steady, sustainable approach to building wealth that adapts intelligently as conditions change. Its sector adjustments aren't flashy, and they won't dominate headlines. But they play a crucial role in making sure that 10 years from now, when I look back at my dividend income, I'll be glad I held a fund that stayed forward-thinking instead of reacting to yesterday's noise. The increased energy exposure reflects confidence in strong cash generation during inflationary cycles. Keeping a solid position in financials prepares the portfolio for more stable banking conditions. Healthcare and consumer staples add defensive balance, and SCHD's strict quality screens ensure every company earns its place. That's more than portfolio management. It's long-term planning built directly into an ETF as we move deeper into 2025 and beyond, with markets grappling with sticky inflation, shifting energy trends, and a cautious Federal Reserve. SCHD's, a blend of quality, resilience, and smart adaptation, fits the environment perfectly. We're entering a stretch where dividend-focused investing may matter more than it has in years. With bond yields potentially trending lower from current levels, stock market valuations stretched in growth sectors, and persistent inflation requiring income that can grow. Quality dividend funds like SCHD are positioned to shine. The changes SCHD made weren't dramatic. They were deliberate. And that's the point. Real wealth rarely comes from sudden moves or perfect timing. It comes from steady, thoughtful optimization that compounds quietly year after year. I'm not here to tell you what to do with your money, and I'm not recommending that you buy or sell SCHD. This isn't financial advice, I'm just sharing my perspective and what I've learned. Make sure you do your own due diligence to see if SCHD actually fits what you're trying to achieve. Do you think SCHD is set up to thrive in today's market? Let me know your thoughts in the comments section. For more strategies to build passive income, check out the video above. See you in the next one.